Tempted by a dividend yield over 10%? Stop right there. It's a warning label disguised as an opportunity that could cost you your entire investment. Welcome. Today we're talking about why you need to stop chasing double-digit dividends. In investing, protecting your principal comes before chasing hype. A massive yield means nothing if it destroys your initial capital. In this scene, we'll explain the sucker yield illusion. A high yield doesn't automatically mean high returns. Often, it just means the underlying stock is collapsing. There are 3 stages to this illusion. First, debate, where you see an unusually high yield of 10% or more and think you've found a bargain. Second, the reality, where the yield only spiked because the share price plummeted due to business panic, debt, or vacant properties. Finally, the trap closes when you buy in, the company cuts the dividend, and you suffer a massive capital loss. Let's look at our first red flag, Gladstone Commercial, or GOOD, offering a 6.8% yield. This is known as the growth for fees trap. GOOD is externally managed, which incentivizes them to grow total assets rather than your per share value. They are currently paying out more than they bring in, with a dangerous payout ratio of 120%. To make matters worse, their dividend was slashed in 2022 and has seen zero growth since, meaning inflation is quietly eating away your real income every year. Next, we have Global Net Lease, or GNL, yielding 8.2%. This is a textbook example of a debt and dilution spiral. GNL relies on aggressive, debt-fueled acquisitions that break down entirely when borrowing costs rise. They recently made a $535 million mistake by acquiring highly specialized buildings that are incredibly expensive to release if tenants leave. Ultimately, they have a long history of persistent overleverage and unsustainable dividends that lead to routine cuts. Our third trap is Dynex Capital, or DX, offering a massive 15.2% yield. This is a true house of cards. They operate with extreme 8x equity leverage, backed by over $8 billion in short-term agreements. To maintain operations, they are diluting shares at a staggering rate, jumping from 42.7 million shares in 2022 to 100 million shares in Q1 2024. In Q1 alone, they issued $411.7 million in stock just to fund distributions, essentially selling you your own money. Let's compare these 3 traps in our danger zone matrix. GOOD is trapped by misaligned external management and stagnant growth. GNL is sinking under a debt-funded M&A spree and a history of routine cuts. Meanwhile, DX survives on massive leverage and massive share dilution. The common thread hiding behind these completely different structural flaws? All 3 destroy your long-term purchasing power in exchange for a short-term cash illusion. To wrap up, you need a pre-flight checklist to help you sleep well at night. Before buying a stock just for the yield, always ask: is the dividend fully covered by actual cash flows? Is the balance sheet healthy? Can they safely refinance debt? Is the management aligned with shareholders? And are the cash flows durable in an economic downturn? Protecting your portfolio from hidden traps is a full-time job. If you want to stay ahead of the curve with the latest news on the stock market, commodities, and other deep financial insights, make sure to subscribe to the channel right now. Hit the bell icon to get our next market warning.